So recently I was watching a Shark Tank, a show on CNBC where you see Mr. Wonderful, Mark Cuban, listening at pitches by want-to-be business people, want-to-be entrepreneurs and so forth. I don't know, and I find the show very entertaining. I really do, right? Very entertaining. I love seeing Mr. Wonderful just being Mr. Wonderful. And of course, I like watching Mark Cuban just because I think his story is very interesting, right? All the things that he's done and owning an NBA team and all the things that he's doing now in the pharmaceutical industry, which is like competing with, the drug companies out there, pharmacy companies out there and so forth. So, so what he's doing is very interesting and I just like that. If you see the way they behave when they see deals coming at them, I just learned from that a lot, right? So, you have to understand that they are business people, right? They own businesses, they operate businesses, and they also are investors. And they tend to have a bit of an influence in the businesses that they invest in, right? And the ones that I've seen that are the most successful at pitching to them are the ones that, have a bit of a business background, if you will, meaning that they understand how investors think. In order for you to persuade an investor, you have to think and you have to understand how investors think. So you have to become not only the person with the idea, but also you have to convince yourself. You have to convince somebody else as an investor. Typically people that are starting a business are caught up in this idea like, oh man, I'm gonna make so much money, I'm gonna be so successful, and like
$10,000, that's a lot of money.
And they do not understand the risk associated with it. Maybe because they have never started a business, maybe because they have never raised money, and that's not their fault. It's just the way it is. So, the way I see it is, there's couple of examples that I could give you, right? So if you have, let's say, I don't know, $1 million to invest.
$1 million? $1 million.
The safest way for you to invest money is just put it in the bank, right? Get a savings account.
I put it in the bank.
Put it on a CD or buy T-bills, right? And by doing that, you know that you're just gonna get less than 1%, right? Maybe 2%. But in today's market, you know that the inflation rate is 7%. Like if you don't have money coming at you from your business or your job at a higher rate, you know that inflation is actually eating your savings rate.
Inflation, increased taxation.
So, yeah, it'll give you safety, but the return on your money is not gonna be as high just because the inflation rate is significantly higher than the savings rate, right? That the bank or the broker company is giving you. So then you go to the next level, okay? You're like, okay, so what if I put money in the stock market? Well, putting money in the stock market is great. It could be a great strategy.
Stock market guy.
If you are that type of investor, right? If you put the money on an S&P 500 and if you see the returns over the last 30, 40 years, it has been close to 10%, right? So if you put money, I don't know, $1 million 30, 40 years ago, you'll have about 10 times your money, $10 million today, right? But you have to understand that, and that's compound rate, right? So that means that the total return, dividends being reinvested, it'll be about 10%. But you have to understand that the stock market has volatility, right? It goes up and down. It goes up and down on a daily basis, right? It doesn't matter when you look at the stock charts. Sometimes it's gonna be up and sometimes it's gonna come down, right? And sometimes you're gonna be very happy and sometimes you're not gonna be as happy just because your investments is actually going down, right? But the stock market historically gives you a better rate than the CD or the T-bills, right? T-bills will give you 1%, maybe 2 points, and the stock market and the S&P will give you, in average, about 10%, right? And potentially you can beat inflation over the long run, right? Another great advantage of the stock market is that the liquidity that's in the stock market. That means that you can pull your money out whenever you want to. Like if you wake up one day, you feel like, you know what, I'm just gonna take out of the $1 million that I put in the market, I need 50,000, I need 100,000. You can call your broker, or you can log into your account and transfer the money, right? And of course, there's tax consequences on that, right? You'll have to pay a capital gain, either short-term or long-term. But what I'm saying here is that there's liquidity in the stock market, tons of liquidity. But some people invest, instead of putting money in the CDs or in the stock market, some people invest in real estate, right?
Real estate?
And let's say you have the same amount of money, $1 million, right? And you get into a deal that requires, 20%. So 20% out of 5 million is $1 million, right? So you put that $1 million into a $5 million deal, that will give you X percentage, right? And you have rental income, you have appreciation over the years, you get depreciation, you hire contractors and a handful of employees to help you manage the project. And it's great. It'll probably give you even more of a return on your $1 million than the stock market. Definitely will give you more of a return than the CDs or the T-bills. The problem about putting the whole deal, the $1 million in the real estate deal, is that there's no liquidity, meaning you cannot pull your money at a moment's notice out of the real estate deal that you just put the $1 million into, right? Like in order for that to happen, there has to be appreciation of the deal. You have to cash flow, you have to show, performance to the bank, you have to show financials, you have to show tax returns and so forth, right? So it takes time for you to put everything together in order for you to borrow against the real estate deal that you just invested money in, right? So yes, it'll give you a high return, but the liquidity is not there, right? You just have to create it, if you will. In order for you to create it, you have to borrow against it, and you have to talk to a bank, and there's a lot of paperwork, a lot of things you have to do in order for you to get some of that money back to your pocket.
I hate paperwork.
So you can also invest in crypto, right? And same deal.
What is crypto?
Crypto can go up, can come down, and if you pull the money, and you're losing money, you're losing money, and there's no advantage for you when you're losing money at all, right? So you just have to understand which type of investor you are, right? You like the no risk, right? You put the money in a CD, or you buy T-bills. You put the money on the market, right? The stock market, and there you, for sure, long-term, you'll deal and beat the inflation, right? You just have to stomach that ups and downs, and you can also put some money, or you put money in real estate. There's no liquidity there. You have rental income and you have appreciation, but in order for you to have a great moment of liquidity, meaning like you need to pull the cash out, you have to either sell the deal, and that typically takes time, or you have to borrow against the asset, or as well as you can put the money into the crypto assets. And that's a great deal as well. You can have passive income coming out of the liquidity pool if you rather put it in the liquidity pool on a stable coin, or crypto like Bitcoin or Ether. But there you have to understand that the ups and downs of the market, and you have to understand there's always risk for you to lose money, right? So there you go, guys. Like, you have to understand which type of investor you are. You have to understand like which method of investing you like the most. Sometimes you like to have some money in cash. Sometimes you like to have some money in the stock market. Sometimes you like to have some money in real estate. And sometimes, maybe like in today's market, when crypto is somewhat down, you want to put some money there because there's appreciation going into the future. There's always an opportunity for you to invest, right? It doesn't matter the type of asset that you decide to invest in. It's a matter of like you understanding the risks, you understanding the type of investor you are, and you actually taking advantage of the opportunity. As always, guys, thank you so much. This is Victor Delerme. I hope you like this video, and we'll see you on the next one.